Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in.
Today's guest is Jordan Nell on the Nomads Fund of Funds team at Hummingbird Ventures. We get into how to identify outlier venture funds, the age-old debate on picking versus winning, and the opportunities and pitfalls investing in deep tech. Today, we are speaking with Jordan Nell of Hummingbird Ventures in Cape Town, South Africa. Jordan invests in both founders and GPs as part of the Hummingbird Nomads team, specifically emerging managers with funds below 150 million. Prior to joining Nomads, Jordan founded a long-short public markets firm and worked as a strategy consultant. Jordan has recently been publishing an LP's Guide to Venture Funds. It's so good. I'm looking forward to your next guide and particularly in what you have to share today. Thank you, Jordan. Can we hear the 411 on Hummingbird and Nomad?
Yeah, for sure. So the background for Nomad, firstly, thank you guys for having me on here, and it's great to see you both. The background for Nomads and Hummingbird, Hummingbird was the mothership. Hummingbird is kind of the starting fund. It's a pre-seed global fund, seed fund. Began about a decade ago, and the guys have had some incredible success. I actually think it's probably one of the top performing venture funds over the last decade out there. And the main thesis there is it's more of a founder profile than kind of a market or sector thesis. It's like the pitch is the opposite of a good founder is a great founder. A good founder is X, Stripe, McKinsey, Stanford MBA, like references well, super coachable. Great founder is non-linear, like a shepherd from Turkey who teaches himself to code or is really hard to get along with or has father-mother issues or something like this. And the model is really kind of concentrated into these few weird people, exceptional people. And then you kind of come in early, you price, you lead the rounds, and you double and triple down all the way through into as much as you can. What if you kind of distill it into the abstract? And I'm kind of spending a bit of time on Hummingbird just because it will inform how we think about Nomads a bit. But the model is like you're global and you're looking for things that others think are noise, weird founder profile, but you see as signal. And then it's kind of more of a non-consensus and right thing than a sector specialist. This, over the kind of successive vintages, informed a lot of the starting DNA for Nomads. Nomads, which began about 3 years ago as a fund of funds, we look for GPs similar to Hummingbird. It's investing early stage, under the radar funds with, say, like 10x potential.
Thanks for that kind of like framework from Hummingbird. Now, with Nomads, you talked about these exceptional people. How do you identify these outlier venture funds outside of just the exceptional people? Because, talking to a lot of different allocators through this research project, they have a lot of definitions on or criteria that they're looking for. So how do Nomads really develop their criteria? What is that criteria?
It's a good question. And I think it's one that's a little bit like tricky to answer because I was just explaining to you guys earlier before, like you don't want to preclude anything. And that's by design. Like there's this cool Thiel quote about rule number 1 in ventures that everything is power law. And like there's really very few companies that end up mattering. So you have to find these and get as much into them as early as possible and get as much as possible in. And then rule number 2 is that because the power law is so restrictive, you don't want to have kind of other rules. That's a little bit how we think about it, is like it's hard to put a checklist manifesto together of what you're actually looking for because you end up being more restrictive than you are bottoms up. The fund math is quite simple for our performance. It's like, it's EV and ownership and then over fund size. So to a degree, you can look for things with a smaller denominator, like this can make it an easier hurdle rate to get to. But generally what you're doing is you're looking for numerator data points, like things in the investment behavior in the past that suggest that someone can have high ownership into companies that are big. This is kind of a bottoms up. You're looking for bottoms-up asymmetry, things that are going to be unusual in the venture fund, but that they have done in ways that is kind of hard to do. So this is quite different, but there's 1 or 2 things that matter in most cases. Sometimes they've been in the room with greatness before and can pattern match to a particular founder profile. Other times it's like they are particularly good at preempting inflection points across emerging tech. And so you're looking for then data points that can validate that what they did in the past or the thesis that they have about being able to do is going to work out now in the present in a totally different circumstances. Most of the time, this kind of comes down to the GP has superior judgment. I think it's more around picking differently than it is like sourcing or winning differently. And there's various GP traits about this, like a signal to noise ratio. They speak with things that matter. They can zoom in and out of their theses with quite a bit of granularity. And they've earned lessons along the way, like they've burnt their fingers. But these are not hard and fast traits. I think one of the mistakes we made in the beginning was to make these things hard and fast traits.
A little more flexibility now. Interesting. And I've seen you write about winning versus picking. Can you chat a little bit about why you're now focused on picking?
I think this is some of a factor of just capital scarcity. Like, it matters more to be able to pick well when access is not as much of a problem, because there's less money in the market, so less deals get done. So it's less competitive. But I also think in the beginning, like what we originally thought of when we came as nomads, we took a lot of the direct steam, and we would index on like nonlinear GPs, things that like speed of decision making, this type of pretty exceptional background person. And this is not exactly a one-for-one translation to what makes a good GP. It probably correlates, but I don't think it's exact. And I think this was a lot of what I started thinking through with the unbundling article. Now I think you have more of a case where there's less competition, and the thing that matters is a GP has an edge in how they see the world. You avoid crowded trades. You go to places that are a little bit less consensus. You kind of think in terms of alpha, beta. And you as the GP, your capital is then the bottleneck, not a dearth in founder profile or something like that. Or founder talent or market depth or anything else. It's kind of what you do is you're giving the founder the money that if they didn't have that money, they would not be successful. This is not always the case when it's kind of flush with money and it's a bit more competitive.
We're going to get into how the industry and asset classes change. But before that, because we're on this kind of thread of how you determine talent, how has diligence changed, or how do you think diligence needs to change for allocators who invest in venture capital, given all the trend changes, all the different funds?
The way we think about it is like there's maybe 5,000 GPs out there. And to go from 5,000 to 1,000 for us, it's mostly like hygiene stuff. It's databasing and screening, and it's the things that every fund does for top of funnel. You can generally screen out on check size and fund size and velocity and the things these imply for selectivity, or the hurdle rate that it takes to 10x. To go from 1,000 to 200, and then we track these 200 closely. It's mostly outbound for us. We do a lot of kind of markets and sectors, and in these places, we're looking for areas where folk can get a relative edge. This is a little bit of the bottleneck that I alluded to earlier in terms of capital dearth, but that process changes depending on what the LP thinks makes a good fund. For us, like we mentioned, picking is a good fund. And so what we're looking for generally there is like we're looking for signal in the track record that they are in great companies. I think the best managers don't come out of the jungle. It's that they're connected with good companies. And so in many ways, our job is kind of similar to a direct fund, actually, where you're looking at companies, you're trying to underwrite the portfolio, you're thinking through how does this GP, where do they hang out that others don't? And what type of people do they surround themselves with? And can I get some kind of data points on one or two of their companies in the portfolio that I can kind of understand their thesis around this company, and I can understand why it was particularly non-obvious. And so for most cases in diligence, it's just trying to spend time finding those 1 or 2 data points that matter.
Are there any people or experiences from your life before Nomad maybe that have been informed how you go about doing your job today? I'm curious if there's any stories you can share.
I mean, my past was more like long short equity, and that's a lot of market thinking, but you can carry over a bit of thoughts around, where do you play? How do you find alpha? I don't think this really carries too much. I think what the people and the examples that have pushed the pattern thinking in venture it's more particular from within Nomads. We've changed the thesis quite a bit over the last couple of years. I think in the beginning, it's kind of, like I said, we indexed a lot on what the direct fund did. And that's been pushed by meeting funds that have been incredibly successful, who look absolutely nothing like Hummingbird. One example is Mike Dempsey at Compound, a fantastic guy, think very highly of them. And what they do is it's the opposite of what we did. So we were concentrated, founder-centric, kind of, there's no crystal ball, market agnostic, and don't really try to predict any kind of market evolution. Compound's completely different. So Compound is research-based, thesis-driven, quite diversified. And in abstract, like I mentioned, that inflection point timing, this is what they do. They were in leading companies in crypto, AI, robotics, tech bio. It's really a little bit more of I go up into my ivory tower and I read shed loads of white papers, and then I come out with a little bit of a thesis. It's more bottoms up than I'm making it sound, but that's basically their approach. This was a nice recent case, actually, the other day, of something where we had to challenge a little bit of the thinking around heuristics on portfolio construction. And then also just what does it mean to have a founder-centric view? For us, it's really explicit. For them, it was we dug into it and it's definitely there, but it wasn't something that they would vocalize. And so this changed a bit of the way that we think about what it means to ask GPs about founders.
So you've written a lot about this next topic, so I know you have a strong perspective. How and why is the venture landscape changing right now?
Originally, I was quite keen on this idea that venture was unbundling. There's access to knowledge, better tooling, individual brands supported by Twitter and stuff. And there's a broader shift from public markets to private markets. I thought that this would mean more capital, and then people index on speed and decision making, and that the value here accrues to long tail of emerging GPs. I'm less convinced of this now. Sam Lesson put out a good thing on the shutdown of the VC factory line. I think this is quite aligned with how we've been thinking over the last year or so. And so I'd point people there. In venture, it's kind of a 2 and 20 structure and pricing. So let me just zoom out for a second. The way that market efficiency seems to work in venture is you have this capital that is the price equilibrium lever, not pricing. And so because everybody charges 2 and 20, it's like capital that arbitrages a market. The amount of investors there are is the likelihood of alpha. This means, this has influenced quite a bit of our thought. Is you can't now index so much on unbundling. Venture has gone back to that scarcity of capital that we mentioned, and you have to be playing this game. You have to be thinking in terms of, okay, where is my capital most useful? How do I avoid crowded trades? How do I think in terms of capital efficiency for my companies? How do I avoid competition? This thinking means that the arbitrage that any specific, specialist specifically fund, it goes away quite quickly. Your fund thesis is arbitraged super rapidly. And I'd say this is true for networks. It's true for idea, whatever it is. So trying to find folk who know how to navigate that rising competition is super, that's what we do. It's looking for people who are not Sequoia and who are going to try and purposefully not try and do what Sequoia does. One of our GPs said it cool. He was if you're trying to think like Sequoia, then you're either overpaying or underthinking, which I thought was quite a cool quote.
Can you share more on what that competitive edge is?
I want to separate competitive edge for a GP out from competitive edge for a company. And I draw that distinction because I think when we think in terms of moats for companies, it's one thing, but moats for GPs is very different. If you like you can build moats around the deployment side of venture. This is like scale, it's network effects, it's brand flywheels, depth of talent that you know. It's like this is a business way of thinking about moats. But I think venture is a lot about taste, and it's more of a craft than it is building a business. And I think that was something that I misunderstood when I first, started writing about the unbundling. I think moats are hard to think about with taste. You actually want someone who's just got really good taste in people that they hang out with. And I think there's a degree that I still believe in that unbundling article, but I think increasingly I'm like, it's more around how you think through the people that you are around and the people that you invest in, and also how you think through the edge that you have in investing. So that, to the degree that you have some kind of non-obvious insight into a company, like that's edge. And the degree that you can validate the founder's hypothesis around why they should build the business that they do, or like to the degree that you can run their idea maze with them, this is edge. And I think that most GPs underweight edge in favor of process, and overweight like sourcing and winning / process in favor of, they think that that's how you get good deals. And that's, I think, actually how you get consensus deals. But that's a little bit of our thinking.
That's really interesting because, in a number of our conversations, LPs have also spoken about how looking at fund managers, emerging or established fund managers, how good are you at actually building this? You are building a company and somebody I want to be in relationship with as an allocator for decades on. So how do you both take on, look for these outlier individuals who have great taste around people they're around, but they're able to actually institutionalize that, codify that to actually have a franchise that'll be successful for long term? Or do you not look for that? You're looking for, hey, something that'll be around for like 2 funds, 3 funds, and then move on.
Yeah, I think this is a structure difference between LPs and GPs. Obviously, as a good LP, I want GPs to take my money, so I want to say that I'll be with them for multiple funds. I think to be super frank, actually, I think that's a lot of the problem that LPs have is you go into this relationship and it becomes a re-up situation, and then you get lazy, and then you don't recognize the changing circumstances around the fund that previously outperformed, and like the things that led to that outperformance are maybe not in place anymore. So when you re-up, it's not kind of what you originally invested in. I think what both should agree to is a commitment to like mutual excellence. So then the LP says, I'll give you money as long as you keep, doing super well. And I think that the GP, what that means to the GP is they need to then be committed to like being a little bit paranoid that their edge is arbitraged. They need to be committed to building continuing some kind of flywheel. Your question around like how a GP should entrench themselves, this is a really good question, and I don't have a good answer. I think we've seen sometimes what it is like it's a fund that moves into a new space, capitalizes on what is initially some picking arbitrage, think like Ribbit and FinTech, or Paradigm and crypto, or like Monashi and Kazek from LATAM. Like there's an edge there because there's no capital going into a thematic trend, and they're the only ones, the big fish in a small pond, and they eat this edge. And then what they do in that process is they build brand recognition flywheels around them by being affiliated with the great companies in that space. And those brand flywheels then carry them on and entrench them. Like this is the standard model, but you move from a picking edge towards a flywheel-driven, top of funnel, winning sourcing edge. And that process, doing that, you scale AUM quite a bit. I would be very surprised if these funds continue to return, multiple fund like 10x after 10x. I think Founders Fund is one of the few that has done this with $1 billion, maybe USV, but I think it's hard. And I think most of the time you have to kind of stay below a certain threshold. As a GP, you have to basically commit to like, okay, I'm going to constantly reinvent myself. I'm going to stay below a certain threshold of AUM, and I'm going to stay generalist. maybe I have sector specialists that come in for a vintage, or I train them up for a vintage, and I have very long-term, like thematic conviction that there's going to be alpha in this trend. But this is a very hard thing for a GP to do, because either you get rich and then lazy, or like there's just not that many exceptional investors. So to build a firm around this type of thinking is tough.
Now we're going to take a quick break to speak with our sponsor. From the co-founder and CEO of Passthrough, we have Tim Flannery. Passthrough makes fund closing simple for funds, administrators, lawyers, and investors. Is there a subset of LPs, maybe through that you guys have through data on the types that are being onboarded more than in the past and when you guys started?
Well, it's tough to tell. When you take a look at dollars are heavily concentrated towards institutional capital and very, very, very large, non-traditional single-family offices.
Yeah.
But when you start to take a look at count, that's absolutely not the case. And so I don't know if the stats off the top of my head, but the majority of dollars committed to Passthrough are absolutely through institutional.
Yeah.
But by far, the majority of investors are non-institutional. There's just a known universe of institutional LPs. Meanwhile, there's about 30 million accredited investors in the United States.
Mm-hmm.
And so that number just absolutely dwarfs it. And I think that's actually one of the challenges that is particularly annoying for funds in the space that we're in, which is I go out and I raise 90% of my capital from 20% of my LPs, but that 10% of capital, if it's my employees, if it's my family and friends fund, if it's the founders in my network fund, that is going to cost me more money and take me more time than all of the rest of my fund put together. And so I've got a choice of, do I forego this or do I not? And what we've seen is that people are choosing to do it because they see the strategic benefits of doing this. They see this as a way to line up people's networks. They also see it as a way to reward their employees and other people that they've invested with in the past. Like this is a benefit to them that they can participate in these kinds of vehicles.
What have you seen as kind of bright spot and I guess themes from standout managers and what kind of they're doing from a tech and service stack to raise in this market?
A few things. One is that they're not losing sight of, even though I have an investment thesis, how I communicate this investment thesis is likely as important as the investment thesis itself. And so firms that have taken time to think about what is my brand and what is my communication strategy, not only have the ability to take their thesis and put it to work, but they have the ability to communicate on their thesis. And that is a really big differentiator. And so spending time thinking about who are all the different groups that I'm speaking to, what are the messages that are appropriate for them, and how can I get that message in front of them? That's a really good place to start. So once you can actually communicate what you're doing and you can run an effective process to go find LPs, convince LPs to come into your fund, the managers that we're seeing be successful are also those that are thoughtful about how they're constructing the rest of their stack. So figuring out how can I go communicate what I'm doing? How can I make sure that the way that people experience my fund is a way that's consistent with what they expect, allows you to actually have the message of the reason why you should invest in me is X, because that's the thing that they're focused on instead of being distracted by the nuances.
What would be your response to maybe pushback of someone who's starting in fund one, or maybe it's even raising out fund two, and still in that period of like trying to manage expenses, right? Because a lot of times some of those things you mentioned more on the service provider side than kind of the tech stack.
Well, your LPs are going to be paying for it either way as a part of fund expenses. And so would you rather have your LPs pay a little bit less for a mediocre experience, and then they're going to have to go spend their time figuring out, okay, I have data requests that I need to go fill, or okay, I need to make sure that when I put a question out to this team that I get a response in time? Would you rather have them spend their time and energy on that? Or would you rather actually have it just passed along in fund expenses and they can get an experience that helps them move forward with their investment instead of just continually being stuck? Depending on who the different groups of LPs that you're speaking to are, when they're thinking about you, they're thinking about how can I invest in this fund and the next fund and the next fund. And so, yes, they should be thoughtful about managing their expenses, but you can't do it at the expense of how do I build a durable firm. And if you think that this provider that you're doing is saving you dollars, there's some places where it makes sense to save dollars, but there's other places that are actually good long-term investments into your fund that allow you and everybody else to just focus on building the generational firm instead of showing you that I know how to go save a couple of dollars. People aren't looking for bargains. People
Yeah.
are looking for investment returns.
Thanks to Tim and the Pass-Through team. To find out how to give your LPs a better onboarding experience with Pass-Through, go to passthrough.com/swimming. And now back to our LP interview.
You're focused on these sub 150 million funds. Obviously, LPs, the others we've had on the show even are far in the other direction. How do you all work together? I think you've actually been friendly with some of our other guests. So, what's that relationship like, LP to LP?
Yeah. Look, I think it's quite similar to venture. I mean, it's FOMO driven. You share deals. You ping people on WhatsApp. Hey, what do you think about this GP? Or hey, I'm doing this fund. You heard anything weird? It's not. I think to the same degree that I would say venture funds that index heavily on collaboration with other venture funds generally get consensus results. I think the same for LPs. It's really good for top of funnel. It makes sure that you see everything, but that's more of a hygiene factor, and I think it should be like a decision-making consideration.
I can relate. Yeah. Makes sense.
We've heard you argue that most fund of funds aren't worth the fees. Could you just share with the audience that argument and where you see the value really is?
Yeah, no, I think I'm in trouble for this one. I think this is an indexing thing. I think there's kind of two approaches to this. What I'm addressing with when I say they're not worth the fees, either it's a global fund of funds that really comes to venture with quite a top-down mentality. I'll have X% allocation to US, X% to Europe, and I'll be mildly overweight, underweight a certain trend. Or you're like a local fund of funds, which is oh, cool, you want Japanese exposure? Well, I've got a portfolio of the top 15 Japanese funds for you. I think with the former, it's kind of looking in the rearview mirror. It's we spoke a little bit around fund arbitrage and all of this. I think what you're doing is you're betting on what has worked rather than trying to gauge what will. And that goes back a little bit to the re-ups thing that I was talking about. I think a lot of LPs get quite lazy. They don't think about the fact that markets have changed, teams have changed. Generally, if a fund does really well in fund say 1, 2, 3, 4, then they've really scaled by fund 5. And just the fact that they've scaled alone means you have to underwrite a very different value prop. I don't think most funds are worth re-underwriting continually like that. Maybe as an LP, you've also scaled though. This is the incentive structure. I think if you scale AUM and you say to your LPs in FOF vintage 1, oh cool, I'll get you alpha venture, then you're doing nice IRR. By the time you're a scaled FOF, you become oh cool, I'm just doing market beta, but I've got a really good access. That's a very different value prop, and I think that most of the time that's not worth the same fee premium. But this is neither here nor there. On the kind of second case with the Japanese folk, I think unless an ecosystem is super deep and inaccessible, it doesn't really make much sense, because definitionally, a local fund of fund is going to have 1 or 2, maybe at best, global maximum funds. The rest is just going to be local median, I think. So I think you dilute returns quite quickly with that.
And in terms of where there are opportunities, you seem to think there's some opportunities in deep tech. How are you sort of thinking about that in terms of manager selection and just in general?
Yeah, that's super cool. I wrote an article on that a while back. I think there's 2 vectors of being convinced of deep tech. There's deep tech directionally, and there's deep tech magnitudinally. I think we're more magnitudinally convinced as well. This is a fairly big thing that I think is not going away soon. That said, I think it's not we're deterministically trend level convinced. It's more about trying to understand the trend and then find specific managers who can have alpha within deep tech. It's not general just indexing deep tech. I think there's a ton of money going into deep tech now, and it's not exactly non-consensus, but there's a really big barrier for smart allocation. And because of that barrier, especially with things like life science, the whole model is different. The whole venture funding model is super different. Things like advanced manufacturing is really a super orthogonal network to what most kind of venture careers gain. With all of these difficulties, you also have a lot of thematic tailwinds. There's more funding, the different hardware, software primitives, talent is being trained. There's a lot of like demographic, geopolitical necessity. These don't necessarily mean that like every deep tech company is going to do super well or every deep tech fund is going to do super well. There's this interesting dynamic in deep tech where there's like not that much talent really in terms of exceptional founders. And so because of these lack of exceptional founders or lack of like really well suited to venture funding markets, you have a case where there are particular companies that do super well. And the minute that they get market leadership, like investors absolutely coalesce around these things. And this is quite unique in deep tech. And maybe you find it a little bit in some emerging markets too. But I think that there's not that many funds that can navigate this dynamic super well. So a lot of like what we said in the beginning about it being, yes, good thematic conviction, bullish on deep tech, it's also going to be very hard. And that's why we generally go with GPs who are pretty familiar with the ecosystem rather than ones who are tourist.
To end our conversation, we always like to ask, is there anything else you'd like to share to our audience? Maybe advice for fellow LPs or advice for fund managers?
I don't have any smart advice on that. But Teddy Roosevelt, what's it? The Man in the Arena speech is like ringing in my ear. The critic who counts. I don't want to be like. So I don't have anything smart to say. Other than anybody who wants to can reach me. It's Jordan at hummingbird.vc.
Well, thanks, Jordan, for sharing your wisdom, getting into a little bit of trouble with some of your answers, and we learned a ton. So thanks for joining us.
Cool, guys. Thanks so much. Appreciate the time and lovely to see you both.
See you later, alligator.
After Portfolio Tile, investing with a smile.